like to take the opportunity to welcome everyone to this panel. And what I'd like to do is make sure that you walk away from here saying that it was worthwhile, spending 45 minutes with us. And what we'll try to do is we'll try to target issues that we think are important, and to the extent that we can make this interactive, I think that would be wonderful. Just let me introduce myself. I'm Steve Rosenberg of Greystone. I'm really honored to do this panel and to have a conversation with Rich Martinez. Rich is now the head of all production for Freddie Mac for the entire country, for multifamily. And all of us in the industry were, actually, we really should give him a round of applause, because the entire industry, because the entire industry was rooting for Rich to get this position. The unique aspect of Rich is, and I said this to him before we came up here, is that whenever he has to say no to a transaction, I know it hurts him. Because Rich is truly an entrepreneur. And the fact that finally Freddie Mac had the wisdom to take Rich and say, you're over all of multifamily production, was an extremely wise move. So Rich, what I'd like to do is we can start off, and maybe we talk about what's Freddie Mac's position with respect to multifamily in the country, and your ability to make loans. Right, sure. For multifamily.
Good afternoon, everybody. It's Richard Martinez with Freddie Mac. I've been with Freddie Mac for a while. Started in the Chicago office, overseeing our Midwest offices, and then I moved back to cover the Southeast and Northeast about 10 years ago. So I've been at Freddie Mac over 30 years, so I've seen a good number of changes, not only in the industry, but also at Freddie Mac. But I also want to thank Steve and the conference host for inviting me to speak and be on the panel. We appreciate it. Our Freddie Mac's relationship with Greystone is very good, very strong. It continues to get better, and under Steve's leadership, we continue to expand it as we do business. Multifamily, boy, I tell you what, it's a good time to be in multifamily. That's what I would say. When you look at the business over the last, 10, 15 years, it's been an incredible run. And I was listening to the earlier panel, and we have some of our good borrowers up there. What we see when you step back from just say multifamily and look at the entire housing market, at Freddie Mac, we believe that there's more demand for housing than there is supply, and that includes single family and multifamily. And while multifamily supply has sort of creeped up and maybe a little bit above the historic average, when you look at single family and you go back and go back to the Great Recession, single family starts were way down. And while single family starts are up, they're not to the level when you sort of combine single family and multifamily starts. They're not up to the combined amount of demand that we see as needs nationwide. And you see that in rents, right? I mean, when you look at the continual rent increases we see every year, when does it stop? Well, the reason it probably won't stop because there's not enough supply to meet the demand for rental housing, or enough supply to basically meet single family. And so the market's great. To give you a sense, we have about a $270 billion portfolio nationwide, and that includes seniors housing, conventional, student, manufactured, urban, rural, ex-urban, suburban, everything, right? High rise, low rise. You can count the number of defaults we have on one hand. I mean, in the conventional side of multifamily, we may have one or two loans in default. We may have one REO. I'd like to take credit for it, but I think a big chunk of it is the markets are really good. And there's really, no any signs of weakness in the markets. Individual market, even not even look at a market. It's not a market. It's not a sub-market. It's micro markets where there might be oversupply.
Rich, from your perspective, is Freddie Mac saying that there is just an absolute national trend that the concept of home ownership has just changed?
If you had talked to me about 5, 6 years ago, I would have said home ownership is going to be difficult for it to come back, but we're actually starting to see home ownership start to tick up again. I don't think we're predicting it'll get to the levels it was in, say, 2007, when it was, I want to say, help me here, 60, 65, 67%. I think it's right a little bit above 61%, right? 67, yeah. That was the peak. I think it went down below. Yeah. So it's creeping back up. But I think that it's going to be, I'd say two things. One, you look at the current millennials and Gen Z, you know, that student debt is an issue. The earlier panel talked about it. People don't want to own. There's more flexibility in not owning. You know, the jobs, jobs aren't paying enough to basically support homeownership. So there's a lot of things that basically point to rental housing.
So Rich, when you trying to address some of the things I think that people are thinking about here, when Freddie Mac does turn a deal down, what are you seeing as the main reasons? Like, what should people here be wary of? Like, don't submit a deal that looks like what? Like, what are the...
What's the old saw in real estate, right? Location, location, location. That is true. As a lender, I think it's all about sponsorship, 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 right? And so for us, the key becomes sponsorship, experience in the market, experience with that asset class. Talking to someone earlier this morning, for us, when you're buying an asset and you bring it in to get financed, if you're projecting a reduction of expenses, explain it to us, right? I mean, if you're buying a property from, I'll pick on Harbor, you're buying a property from Harbor, should they ever sell. Harbor sells a property, you tell me you're going to reduce expenses from a property that Harbor manages by 15%. They're a great borrower. What are you seeing that they don't? You got to explain that. So when you're buying something and you're going to reduce expenses, please explain it. Yep. You know, that helps. We may buy it, we may not buy it, yeah. But you know, we buy the story. But that's one. The second is, show us your real estate tax analysis. The earlier panel also mentioned that. That is a key variable, the real estate taxes, and we all know nationwide municipalities are really going after owners of multifamily, and we're seeing a lot of pressure on real estate taxes. And that's a huge number in your pro forma. So, you know, show us your real estate tax analysis.
How important is borrower liquidity for you? You know, in the CMBS market, the focus is almost totally on the asset and the cash flow as opposed to the sponsorship.
Right. We have a rule of thumb. We like to see about 1 times debt service. You know, one times annual debt service and liquidity.
Got it. And what about foreign nationals that want to own? We're seeing a lot of like international buyers coming in. I think multifamily seems to be almost the global real estate asset class of choice these days.
You need to be domiciled here. We want cash parked here in the United States, and then you've got to get through the know your customer regulations and FinSec. I mean, I see my friends from Capital One here. Other banks are here. They know that the vetting of borrowers is time consuming, and there's a process you go through. The vetting of foreign nationals or foreign funds is even more intensive. There's a lot of focus and concern on that.
Right. There a lot of the multifamily owners here have historically been primarily owners in New York City. Mm-hmm. With all of the all the new regulations that are really hurting the market values of multifamily in New York City, do you see that Freddie Mac can come in and somehow be helpful to that situation? I mean, a lot of banks are sitting now with loans on their books that are over-leveraged. I mean, a lot of buyers or investors had come in assuming they could buy it at 2 cap rate and take it up to a 12 cap rate because of the rent increase. But
Steve and I, we talked about this last week. We want to be helpful, but we don't help them so much that they compete against us. So we'll help them out if they promise to stay out of the multifamily market. I don't think we fully know exactly what the impact of rent regulation in New York State is going to be. It's clearly going to have an impact. I think when it initially passed, we thought there would be a 10% reduction of value. I think you and I spoke last week. You thought it'd be something greater. Unfortunately, I missed the earlier panel, but it sounds like it's evolving into it's deal by deal. But clearly, there's going to be an impact on the market in terms of values and value reduction. Mm-hmm. We plan for 10%. I think we're going to do 2 things. We think it'll at least be 10%, would probably be something more. And we're also basically looking to make sure we properly underwrite maintenance expenses as well as maybe build up a bigger reserve. And concerns will be that there's sufficient cash to put back in the asset should it need it.
Right. Because we're seeing a lot of, and probably everyone here is seeing also that a lot of the owners that were primarily New York owners are now moving out of state. How concerning is that to you that you have experienced New York City or New York multifamily owners now that are going to the Southeast, to Texas, to Alabama, to all different places? How important is having a local operator to you when you look at deals like that?
I mean, everyone is successful. You know, they wouldn't be in the business, right? So they're successful and they're very good at what they do. The only thing I look at it when you're going to Atlanta and you're buying a property in Atlanta and you own nothing in Atlanta and you're coming down from Jersey or Philly or New York, wherever. What do you see in the value of the asset that a lot of the owners in Atlanta do not see? Right? That's the question I ask. I said, there's a lot of good multifamily owners in Atlanta. What do you see that makes you pay that price that no one local sees? I mean, that's the question. I saw this, I covered Texas for a long time, and you saw a lot of California borrowers move from, they do 1031 exchanges, and they'd move to Texas. They say, oh, look at this, I could buy this property in, I'll pick on Arlington, south of the airport. I can buy this for a 5.5%, 6% cap rate. Well, it made sense from a California cap rate perspective. It didn't necessarily make a lot of sense from a Texas cap rate and what properties we're trading for in Arlington. Not to say that you can't be successful, but it's a question of like, what do you see when you're paying more, in particular if it's substantial, and a little bit more than locals are paying. So if you're in Birmingham or you're in Kansas City, those markets have good owners. What do you see that they don't see? And then if you're coming in and the play is you're going to reduce expenses, right? The way you get to justify your cap rate is you reduced your expenses. Well, then please explain to me, help me understand your story, right? How are you able to reduce expenses in whatever market you're moving into that no local owners who've had it before you've been able to do?
Yeah. So,
It's not to say we won't do the loan, but these are questions we ask.
Yeah. So I guess one point that I would make is that one of the ways that owners that are here have been able to compete with local owners has been, what I've seen is the ability to aggregate equity that doesn't require as high a return. And so to the extent that you're able to access international equity, and as I said before, I'm seeing more international equity looking to invest in multifamily now than ever before. And for some reason, New York owners have better access to that capital than someone sitting in Alabama.
So my counter, I agree. And so I would say, that's great. Why don't you put more equity in and reduce my loan to value? So if you're buying it, you're buying it for 20, instead of lending 80%, how about if I lend you 65? And I'll tell you what, I'll even give you full-term interest only to pay that return to your investors. Now, you've got 35% cash in front of me. I'm feeling better at 65% in case you overpaid, and you can pay your. Where it gets concerning is you want 80%, you've got that cheap equity, and you're getting there by reducing expenses and reducing vacancy. Right. And so it's like,
Yeah. So I totally agree. I totally agree with you.
I'm a lender, right? So this is half empty, right? I mean, so it's my lens. I'm sorry.
Yeah. But what we are seeing is that the equity investors right now, everyone is hungry for yield,
right?
And they are competing with each other. And we're seeing mezzanine now, mezzanine behind agency lending, right, going in at 5.5% to 7.5%. So it's really there's really a hunger to get capital out the door, and we're seeing interest rates coming down, and also required equity returns coming down. And I think, at least what I've seen is that people that are in more, let's call them sophisticated capital market centers, are able to access that equity, and therefore being able to pay more than maybe the locals that are just still doing things with friends and family money.
Sure.
But yeah.
I mean, we have seen a bit of a transition, in particular in the value add, where I would say in the last 5 or 6 years, to your point of equity being more available, is people went from higher leverage with pref equity or mezz to more equity in the deal, to get to more, we're a lender, right? The lower your loan to value, the more interest only we're willing to provide. So, we've seen more people deleverage the going in. and to get more interest only to pay the return, rather than basically try and achieve your return by sort of leveraging up with our debt and with pref behind it.
Yeah, the other thing that we're seeing also, Rich, is that so we just purchased a publicly traded REIT that focuses on affordable housing. And what that REIT does is they're financing, because they're using tax-exempt bonds, they're financing pretty close to 100% of the capital stack, very close to 100%. But the way I'm seeing sophisticated owners of multifamily behave is that what they're also doing is, behind the senior debt, they're issuing a tax-exempt bond, right, to someone. They're privately placing it, and that equity investor that would typically require, let's say, a 10% return, is more than happy to take a 6% return, which more equates to a 12% after-tax return, if you can structure it as a tax-exempt bond financing. And I know that Freddie, in that tax-exempt bond world, is really a leader, right? I don't think there's anyone that has the Freddie TEBS program the way you do.
Thank you.
But
I mean, you're doing that, but it's coming with restrictions, right? On the rent, it's affordable housing, so you're willing to
qualify,
right? To achieve the goal of more affordability, you may be willing to live with more restrictions. Therefore, you may modify and take more leverage and take a little bit more risk to get that. But a straight conventional deal, it's different.
Absolutely. In fact, what we're seeing people doing now in the market is properties that you're buying that may have, tax-exempt bonds outstanding on them. What people are doing, what we're doing for them, is refinancing those bonds with conventional debt, but not paying the bonds off. We're using them and moving them to a subordinate position, and essentially using the bonds, even though it's called debt, equity investors are buying them and getting that yield. So we're definitely seeing this type of creativity happening in the market, which really allows people to pay more for properties.
Absolutely.
Right. In terms of new things on the horizon that you're thinking that Freddie Mac is thinking about doing, for a while, Freddie Mac was thinking about, David was always talking about, David Brickman, the ex-head of multifamily.
Our CEO.
Right. The current CEO was talking about construction lending for affordable. Is that kind of on hold for now?
So let's go back. So to put it in a bit of context, right? So we have a mission, right, as part of our charter, and that mission is to provide liquidity, stability, but it's also to focus a lot on affordable housing. And so we're a lender, right? So what can we do to basically promote affordability? And because that is we believe there's an affordability housing crisis, right? And we can come back to that because we haven't addressed it. Your residents are, and it's called rent control, right? So that's how they're dealing with the affordability crisis. They're taking it through law. But anyway, so one of the things, what can we do as a lender? Well, we don't want to necessarily compete on conventional deals. We thought we came out with a mezzanine program to provide more leverage, in return for which we would put rent restrictions on some of the units, not all of them, but some of them, and tie that restriction to our mortgage. So we rolled that program out. The second thing we tried to develop was a construction program that would also have rent restrictions on some percentage of the units that would burn off once the property was stabilized and the current mortgage. So we were going that way, using whatever tools we could, higher leverage, lower spreads, et cetera. With the shift in the regulator and the focus on the agencies exiting conservatorship, the new regulator has come in and basically has indicated, and it makes sense. He said, if you look at your capital, you have $3 billion of capital. That's all you have been allowed to retain. And you have $1 trillion. The market next year for single family is going to be $2 trillion. And Fannie and Freddie are a significant part of it. You're over leveraged. And so he said, to exit conservatorship, I'd like you to focus on three things. One, you need to de-risk your portfolio. Not that the things you're doing are risky, because our defaults are very low, but you're taking on more risky products that your capital base shouldn't allow. And so you need to, one, do two things. Build up your capital and de-risk until such time as your capital and your risk are equal. And then once your capital continues to build, you can take more risk. So To help exit conservatorship, you need to de-risk. You need to focus on profitability, and then you need to clean up internal audit stuff and financial reporting. And so we're doing that. So to that end, what he said was, construction lending is probably the riskiest part of lending you can do. And so, you know, I applaud your goal of trying to create affordability, but let's take that off the table for now. Your mezzanine program, which leveraged up, but also providability, I'm going to pull that back too. And we had a couple other external initiatives that he basically they've pulled back, FHFA has pulled back at the current time. Like I say, they want to de-risk the portfolio a little bit to make us more attractive for capital, private or public capital to come in. And so our innovation, you know, we still want to be innovative, but right now, while we're, you know, preparing to exit conservatorship, the focus has become more internal innovation, getting better at our process, better at our execution, taking the friction out of the process. You know, like ordering a cab. Remember the old days of ordering a cab? You'd call, your cab will be here in 15, 20 minutes. It never came. Now, you know, you do an Uber, right? That's frictionless. That's the way we want to get to that point for making a mortgage, whether it's single family or multifamily. Long way of saying innovation externally has been pulled back on both single family and multifamily until such time as we're able to exit conservatorship.
Is Freddie Mac investing in terms of that frictionless loan? Is Freddie Mac spending a lot or investing in technology?
Yeah, I don't know if anyone was in the prior panel. There was a gentleman that asked a question. He said, you know, he's been looking at technology in real estate, and he said he didn't see how technology was disrupting real estate. And I thought that's interesting because technology is really, you know, when you do it every day, it's hard to see. But step back and look about how did you lease an apartment 15 years ago? How did you handle your work orders 15 years ago? It's probably not the same today as it was 10 to 15 years ago, right? There's more technology involved. When your tenants shop your apartments, they're online looking at them, probably late at night. You know, they're not necessarily parading through between 9 to 5. And so technology has changed the way you as owners lease and handle work orders. Technology is changing the way lenders, you know, change. Now, I will admit, as lenders, you know, we're slow. We're behind the times. I think Freddie Mac has put a big emphasis on changing the way the business is originated. One of the biggest one we want to do is more transparency. So think about it. You have a loan request. You submit it to Steve at Greystone, and then he submits it to me. And what's going on? You have to call. Why can't you log on? You should be able to log on and see what Greystone's doing with it, and at the same time have transparency into where we are with the process. Maybe we're hung up on the taxes, right? So we're doing a tax analysis in Florida, and we're hung up on how they're handling taxes in Gainesville, pick a city. I've got the analysis. You can see where we are. You can front run the process, right, and submit the information. So we're trying to provide more transparency into the process, both for seller servicers like Greystone, as well as borrowers. We just want to make the process less friction and more open. The third part of technology that I think is out there that was touched on a little bit was from your tenant's perspective. How do you think Airbnb works? How do you think this home sharing works? It's because the tenants are able to basically interface with Airbnb and be hosts. I mean, technology has enabled this whole home sharing phenomena that is out there, and believe me, it is out there. Do not think it's not occurring in your properties. It is occurring. You may not know it, but it is out there. We had an owner who has 80,000 units. I don't know how many, maybe, I can't remember how many properties, but every single one of his properties has an Airbnb unit in it one time or another. And we're not talking New York City, Orlando, the big vacation areas. We're talking Amarillo, Texas. We're talking Galveston. Small markets. It may be one or two tenants, but it's out there. Anyway, technology enables those tenants to interface with Airbnb and others to basically do home sharing. So technology is coming. So it's proceeding apace. Whether it'll be as disruptive as Amazon or Uber has been to some of those industries, I don't think so. We want to think it's going to basically make the process quicker, faster, more efficient for you, for us. Maybe reduce the cost of making a mortgage. Certainly reduce the time frame. From our perspective, from the time we commit, we hold our spread to you for X number for 60 days. Then we've got to basically aggregate it and sell. we have exposure for, maybe 6 months, 4 months. We want the process to go sooner, so our exposure to securitizing becomes shorter, and we're not subject to market variation.
Yeah, I think from our perspective, I think Greystone's opinion on the market is just like Rocket Mortgage came in and totally, changed the single-family market. There's absolutely no reason why the commercial market shouldn't be exactly the same. I mean, you should be able to, as an owner, you should be able to put the address in of the property, and based on just publicly available information as to what rents are in comparable properties, you should be able to get a loan quote in 10 seconds.
I couldn't agree more.
And we see it happening. My view is, right, if we don't disrupt the market, we'll be disrupted. Right. There's no question about the fact that someone's coming in and loans will be done in a couple of seconds. And, if you're not the ones that do it, you'll be out of business. If you are the ones that do it, hopefully you'll be, that'll be a win. We definitely see that.
Are there any appraisers in here? There's an appraiser too. I mean, who knows more about multifamily, let's say New York City or the markets, than the audience here or Freddie Mac or Greystone? I mean, this is all we do. And if it's an acquisition, I get an appraisal. That's great. I got an appraisal that tells me what the value is, but you're paying for it. That's market. That's value. But yet we have to wait. How many weeks do we have to wait while the appraisal is completed? We got to move beyond that, right? Same with environmental searches. Okay, been searching on that property for how many? Property's been financed a half a dozen times. Every time there's an environmental report. I mean, come on, we got to speed this process up. Well, let's do what we can to shorten it. That's what can we do to shorten it up, make it easier for you, and make it easier for us.
Right. Do you see in the next couple of years, besides getting out of conservatorship, do you see Freddie Mac being a private company?
It's not up to us. It's up to Congress and to the administration. They've announced their plan. The FHFA is very focused on having both agencies exit conservatorship. They've given us a scorecard that has both external facing and internal facing. The internal facing is preparing to exit conservatorship. We're doing everything we can to be prepared to exit conservatorship. Whether it's attracting private capital or public capital, we want to be prepared to go either way. Our regulators laid out a few things, de-risking. How do you attract capital, right? You want to make it a safe investment, you want to make it a profitable investment, and you want to make it a clean investment. By that I mean good financial reporting, no what they call material MRAs or internal audit issues. Anybody who works at a public company knows that. So we're doing everything we can internally to be prepared. It's a lot more complicated how we get out, but I can tell you there are a large number of people at Freddie Mac that are entirely focused on meeting the direction that the conservator has provided to us, which is to basically prepare to exit conservatorship. It's got to end sometime, right? Yeah. And we would like to do what we can. And there's momentum now that hasn't been seen for some time. Right. Listen to the director of the FHFA. He speaks about it almost every time he gives a speech, and he's very public and very vocal about it. We're fully supportive and doing everything we can to basically follow their lead and whatever they can.
Right. So, and at this point, then the regulators have said that Freddie Mac, they've capped the amount of business you can do at about $100 billion over the next 5 quarters.
Correct.
Right. And what they've changed that I don't know if people are aware of is that there used to be parts of the business, whether it was affordable or some other aspects, that were outside of the cap. Now everything is inside the cap, and so that's, do you think that's going to be a limiting factor for you?
It was interesting. So the new director came in, and the new regime came in through the regular, and they wanted to change it up. They looked at what we were doing, and we had a hard cap of $35 billion, yet last year we did, let's say, $78 billion. It's like, well, wait a minute, so you're doing more business outside the cap than in, and what's in the cap? And I'm not sure this makes sense. So they just said, let's just make it simple, right? Just give you a hard cap. You can do X billion a year. And so they tossed around a few numbers. They said, okay, let's basically say for the last 5 quarters, and they rolled this out in September. They said starting October 1st through year-end 2020, you can do $100 billion. Roughly, pretty good with math, $20 billion a quarter over 5 quarters. And so that's what we're managing to. I think we're still looking at year end. So I think our goal is to end the year of 2019 close to what we did, plus or minus where we were last year. Last year we were like a 78, 79. That's our target for this year. We ended the third quarter at $60 billion in multifamily. So do the math, 60 billion plus 20 gets you to 80 billion, right? So if we do 20 billion in the fourth quarter, it's about what we did last year, a little bit more, maybe we do a little less, and then that sets us up to do 80 billion in 2020. As a limiting factor, we've never done $80 billion, right? And the other thing I'd say, there's more competition. When the agencies sort of step back a little bit in the summertime, some would say a lot, maybe a little bit, other lenders step forward, and they're still there. So CMBS is still a force. Debt funds, private debt funds are still out there. Life companies have stepped up. Banks have stepped up. So there's more competition. So hitting $80 billion, it's not going to be easy.
Yeah. So I think the one question that a lot of borrowers have, and even as a lender, we have also, is that historically, as Freddie or Fannie have gotten close to their caps, then they start tapping on the brakes.
Right.
And then credit narrows. And so, is that evaluation something that happens quarterly or?
Yeah, I would say last year we were probably running cold early, we ran hot. But anyway, I'll go back. So starting in about April, we thought we were getting very close to our cap. And so, you're good business people, we dropped the pricing on our uncapped business and moved the business that way. New regime at FHFA, we kind of started getting signals that they didn't like this capped, uncapped regime. And honestly, our competitors were complaining about our footprint. They didn't want us to be, too big, because we're taking business away from them, particularly multifamily. So we were like, we need to manage to roughly $80 billion. What we started doing was then to better manage our business. Prior to that, our mantra was grow to the sky, do as much as you can. Too much is not enough. You do as much as we can. Trees go to the sky. We want to do every multifamily deal we can. That changed. We had to change that thinking. So now we had to work into a limit. So to that point, the regions and the business lines, we competed against each other. So if I was in the Southeast and the Northeast region, I wanted to do as much business as I could. In the West Coast, they did as much as they can. We worked together, but we competed against one another somewhat, to some extent, not badly. Now we have to work together to hit the limit. So now what we're doing is we're meeting on a weekly basis, and we look at the number of deals that go under application the prior week. We look at what we're losing. So we're looking at what we're winning. We're looking at what we're losing. Where are we losing? Is it credit? Is it price? And we make adjustments. To hit $80 billion a week in 2020, we need to sign up about $1.5 billion a week, plus or minus, right? And so we're monitoring that. If we're running hot, we may dial it back a little bit. If we're running cold, we may tune it up a little bit. We're also looking at product lines, right? So we've got business lines, you've got target affordable, you've got conventional, and then you've got small balance loans. And combined together, they have to be 80. So we're looking at it on a weekly basis. Where we're running hot in SBL, we're running hot at target affordable, conventional. Where is it profitable? Are we winning a lot of business that's not profitable? Or are we winning business that is profitable? What do we lean into? And then we're looking at products. How are we doing on seniors? How are we doing on student? How are we doing on lease-up deals? And so we're meeting on a weekly basis with capital markets, underwriting, and production, and we're basically just assessing how we are. The point of all this is to basically reduce the volatility that you experience from us, to be more consistent, so we're not lurching from one direction to the other. And, as stressful as it was for you, it was stressful internally in terms of trying to manage to this hard cap. So to answer is a long answer to a very simple question. I think that what we put in place starting in April of last year, that we've been running, sort of test running through the end of this year, will help in 2020 to basically more modulate the business, and you won't see the variability of pricing and credit in and out of the market. We want to be a consistent presence.
So I guess what you're saying is that if I'm making an acquisition, and if I can close this year or push it to January and close it in January, what you're saying is that it's not necessarily a good bet that credit will be looser in January.
We like where credit is. I mean, the other thing, so once again, let's go back to some of the things. The regulator de-risked the portfolio. They're monitoring very closely what we're doing with credit, right? And if you look at credit, like we're holding the line on debt coverage ratio at 125, and we're holding the line at 80%, okay? Where we're getting pushed as a lender is on interest only, and they are very focused on how, we have an interest only policy. When we deviate from that policy, they want to know why. Why are you deviating from that? Not individual loans, but on a monthly basis. They're tracking, they're called exceptions to credit policy, right? So they're tracking the percentage of credit exceptions that you do, right? And they're like, well, why are your interest-only credit exceptions up in the month of October compared to prior months? And so we're managing these credit exceptions, and the push on credit is interest-only. Going back to your question, no, you shouldn't try and game Freddie Mac or Fannie Mae, for that matter, in terms of what our pricing or credit will be from one month to the next. We're trying to remain consistent. I go back to what Jordan said and what Ron said, which was basically, if the deal works, it works, right? I mean, you can't outthink the market, and you can't outthink lenders.
Are there any asset classes that, even though, again, before this overall cap took place, there was that uncapped business, the affordable deals, for example. So even though it's still, now it's part of the cap, are there asset classes, is affordable housing, whether or not it's Section 8 or workforce housing, something that Freddie Mac wants to stretch more on than luxury housing?
Yeah. I mean, we believe there's an affordable housing crisis, right? And so we want to do everything we can to lean into it within what we have, with the tools that we have. So affordable will continue to be a big focus for us. We've taken it, Dave Leopold, who used to run our affordable group, took it from $2.5 billion up to $8 billion over 5 years. We want to continue, I'm not sure you'll continue to see that growth, but we want to continue it at $8 billion plus or minus a quarter. Senior housing has been a great asset class, it continues to perform well. It's a smaller percentage of our business, but we're still committed to the space, we still like it. The one asset class, if you're looking for an asset class that's underperforming, is student housing, which is painful for me to say because I was the lead for student housing at Freddie Mac. I kind of developed the program. I like student housing, but it's underperforming. I think it's oversupplied in certain markets, and we have more defaults in student housing than we have. If we have 5 defaults, I'd say 3 or 4 in student housing. Maybe one's conventional.
And why do you think that is?
It's overbuilt. I think the market's overbuilt. The two things. The people in the student housing space do not agree with me, but I think it's overbuilt. They would argue they're replacing old housing. I would say, you continue to build 35 to 40,000 beds a year. It gets overbuilt. And what happens is, it's a leasing cycle only runs once a year, right? It's September and then September. So you miss the market in September, you won't lease it up again until next September. So you're sitting there at 20, 30% vacancy for the full year until you get to next September. And you better hope there's no more units being delivered. That's one. I think part of what's driving the construction is institutional equity, while flocking to multifamily, is definitely flocking to student housing. There's more institutional equity and institutional debt in student housing. And not to mention foreign money, Middle Eastern, Asian, they love that space. And it's like anything, right? Too much of anything sometimes isn't good, and there's too much. I believe, this is just Rich Martinez's personal opinion, that the people in student housing do not agree with me, that too much equity has come in and is generating too much pressure on cap rates, too much pressure on construction. And we're building when maybe we don't need to build.
Interesting.
It's not. It's just small. I mean, if we do $2 billion a year in student housing, right? So we're going to do $80 billion. Student this year will be 1.5. It was 2 last year. It's not a big chunk of our business. But I have 5 defaults, 3 or 4 student. It's like, it's not the right ratio.
Interesting. In terms of the affordable business that that really hits Freddie Mac's sweet spot? Is it just the definition of affordable from your perspective? Is it just tax credit deals? Is it Section 8?
Yeah, there's two levels we look at it. There's two levels of affordable. One, there's the mandated federal government definition, which we call targeted affordable housing. It's bond deals, it's LIHTC deals, it's rent restriction deals, it's regulatory deals. Those are hard caps. Then the other thing we call, that's capital A affordable. There's small a affordable, which is workforce housing, which varies by market. So what's a affordable deal in Atlanta is different than what's an affordable deal in New York City. I mean, one of the we look at is Peter Cooper Village, right? The New York City granted they waived recordation taxes if they agreed to keep some units at 150% of area median income.
Right.
So we kind of viewed that as the New York City determining what workforce housing, small A affordable housing was for New York. If you go to Jonesboro, Arkansas, you know, the affordable housing, workforce housing is not 150%. It's something much less. And so what we believe in, what we've advocated for with our regulators, that you need to look at affordable housing or workforce housing on a local basis. And so what's affordable in Baton Rouge, Louisiana is different than what's affordable in Minneapolis, which is different than affordable in Boston, which is different than Phoenix. And that affordability is really a workforce housing, small A affordability is really a function of your local market.
But the desirability of Freddie Mac for affordable housing, let's say workforce housing, as opposed to the hard and fast affordable, is there a stronger desire for
Yes, absolutely. I mean, life companies do a great job on the brand new construction, super class A. We like financing that also. That we view our mission as workforce housing. If you look at a bell curve and affordable housing, luxury housing over here, our bell curve is more to the left. We're shifted more to workforce housing, to target affordable housing. That's our mission.
Right.
And we think that's, and depending on how we exit conservatorship, we're prepared to meet that mission. Right.
So large luxury housing properties are things that you probably want to stay away from?
I mean, we do it. I mean, so there's a lot of people from New York City, right? Okay, so we see properties trade in New York City for $1 million a unit. You know, so sometimes we're asked to finance it at 50%, right? So it's 500,000 a unit, 50% loan to value in New York City, but it's still $500,000 a door. Where else in the country does property trade at $1 million of value, or even at 500,000? Not many markets that meet that. And so, you know, you have the optics, right? So we're in conservatorship, we're regular. We've got to look at the optics of what we're doing and where we're lending. You know, as a lender, as someone paying for it, right, you want to be associated with the glitziest and the nicest, but sometimes from an optics perspective, it's better to that could be served by different lenders. There's a lot of capital out there.
Yeah. Well, we have just a couple of minutes left. I'm just wondering, maybe we should take some questions.
Do you see it going nationwide? The West Coast has been.
Earlier panel, Ralph talked about red versus blue. I mean, I find it hard to believe that Alabama is going to have rent control anytime soon. I'm not saying it doesn't need it, but the mentality of working there is different than the mentality of working in Oregon or certain parts of California. It's the general statement. I don't know.
Like down south, like Georgia, Florida, Texas.
I mean, I don't hear any talk of it.
When you come out of the conservatorship, is that going to change your funding ability?
Depends. I think there has been a recognition. I believe the regulators talked about it, and this is up for Congress and the administration to determine, right? There's some talk that Freddie Mac and Fannie Mae would continue to have an explicit guarantee. We'll have an explicit guarantee of our mortgage debt, for which we will pay the federal government a fee. And then with credit risk transfer, we're not passing on 100% of the risk. So when we securitize loan, the risk would be the B piece would have the first risk. Freddie Mac as a company would have its capital at risk, and only then, after you burn through the B piece holders of the securities, Freddie Mac's and Fannie Mae's net worth, only then would you get to the federal guarantee.
Yeah.
Now I'll just say, if there is a federal guarantee, then that comes with a mission. If there's no federal guarantee and we're a private company and we're just another conduit, we're going to look very different. Probably be smaller, more targeted.
Yeah. I would say, though, that because of your extremely low default rate and the fact that we're seeing that the market that's buying B pieces when you're securitizing, the interest rates are really coming down on the B pieces. And I think that's a strong indication of the comfort that the market has for the way you underwrite.
Yields are very
So
low,
I would venture to say that if and when Freddie Mac goes private, that I think their acceptance in the capital markets, in the international capital markets, I think is going to be very strong. I would be surprised if they negotiate a fee that they have to pay to the government to get better access to pricing. I don't necessarily see that happening because of their history.
I mean, internally we charge ourselves a fee. We get charged. I mean, we'll see what the administration and Congress, how we exit conservatorship. There's several different ways we can come out. I think we are preparing to exit conservatorship. We'll dance fast, right? If we have the guarantee and that comes with certain obligations, we'll adhere to those. If it doesn't, then we'll pivot and compete. True NOI growth. I mean, we're looking for income growth. We're looking to achieve NOI growth, right? When we look for someone requests a supplemental to leverage the loan back up, what we're looking for is true NOI growth. In other words, it's really primarily have you increased your income. What we don't want to do is make a loan and come back later. Well, the cap rate's gotten compressed, and two, I've cut expenses to the bone, but my income's flat, so my NOI is up. So you'll see us, we'll look at the NOI growth and have that NOI grow, and we'll probably go right to the top line, look at income growth. And that's great that the cap rate compressed, but they can also widen too. So we don't want to make supplementals based on cap rate compression and expense cuts. We want to see income growth.
What does the perfect sponsor look like to you in terms of loan?
I don't think there's no such thing. There's no such thing as perfect anything, right? So I don't think there's a perfect sponsor. I think you look at the sponsor, their experience relative to the loan request, right? And where's the property? What's the property require? So you look at past history. History is a precursor to the future. I think one of the more difficult things for us as a lender to get over, I call it the scarlet letter. It used to be the scarlet letter was A. Well, the scarlet letter for a lender is B. It's bankruptcy, right? Single asset bankruptcy. It's a delaying tactic. Absent bankruptcy, and we haven't seen too many. We will work through pass. You want to experience people. I mean, there's a loan for everybody, right? I mean, my comment is you want to treat people fairly, and not everyone's equal, right? Not everyone has the same experience, has the same net worth. So your loan terms may vary. I may lean in with some borrowers, and I may lean back with a few others.
One thing I would say, just to comment on that, is that everyone hits bumps in the road from time to time. What I've seen with Freddie Mac and Fannie Mae also, it's how you behave when you hit those bumps in the road is really, really important, right? If you're transparent and you work with the agencies and you don't take a litigious or a confrontational angle on it, the agencies just don't forget. And so I think that's really how you behave, right? You got to be a mensch.
Yeah, I mean it's how you handle yourself. But in terms of putting the bad stuff aside, it's really lining up your experience with your request and what you're trying to do. Is there a match? Are you overreaching, or it's a perfect match? So I think we deal with a wide range of clients. And our Greystone and our other seller servicers do a great job of vetting them and bringing them in.
All right, listen, thanks everyone for joining.
Thank you.
Rich, thanks so much.